Everyone, myself included, is always saying that you need to be investing in the stock market. But what does that even mean? I've been trying to break down financial independence into bite-sized chunks so that you can digest the information more easily. But I realized that I've been leaving out something really important: what to actually invest in. In this video, we're going to talk about 2 of the easiest ways to get started investing in the stock market. Hi, welcome back to MyFiMap, the one-stop shop for your financial independence journey. My name is Chris, and I'm here to teach you everything that you need to know about financial independence, from budgeting to investing to automating your finances and more. If that sounds like something that you'd be interested in, hit the subscribe button and the bell icon so you don't miss a thing. As you know, this is just my opinion, not financial advice, so make sure that you research your own investment options and don't just buy something because I said to. So investing. We're all starting from different places, and I get that. Maybe you know that some companies have stocks and there's mutual funds and index funds, or maybe all that information is completely new to you. Maybe you're further along and you're trying to figure out, how do you pick a stock? How do you know which companies are good to invest in? How do you research companies? Whichever boat you're in, that's totally okay. The world of investing can feel super intimidating and complicated. And can I tell you a secret? That's intentional. Many financial advisors have incentives if you use them to invest. So Wall Street has developed their own jargon and complicated systems specifically engineered to make you feel like an outsider who can't invest on your own. I'm here to tell you differently. You can invest successfully, and you don't need to pay someone else to do it for you. There's a common stat that's thrown around. The stock market, since its inception, has averaged 10% growth every year. This doesn't mean that the stock market has gone up 10% every single year. Sometimes it goes up more and sometimes it drops for the year. But on average, the stock market is going up. The question is, with over 4,000 public companies in the United States alone, how do you know what to invest in? Today we're going to talk about 2 different options: index funds and target date funds. Funds are just a collection of stocks, like Apple or Microsoft or Nike or Tesla. But instead of buying all these companies individually, you get to buy one fund and get 10 or 100 or all of the companies in the stock market. Index funds are a group of stocks that are selected to fit a certain set of criteria. It might be a sector fund like EV or technology or airlines, or it might be a market fund like the Total Market Index or the S&P 500 fund. Some people ask themselves, if the stock market grows by an average of 10% per year, why not just invest in the whole stock market? That's why funds like the Total Market Index Fund were created, ticker symbol VTI. The S&P 500 fund averages slightly better. The S&P 500 is a list of 500 of the largest companies in the United States, and every quarter that list is reevaluated with some new companies added in and some old companies taken out. There are a bunch of different ticker symbols, but the 2 most common are SPY and VOO. Target date funds were created for people specifically investing for retirement. The general idea is that investors of different ages have different appetites for risk and different needs for stability in their money. In general, if you're younger, you want higher growth opportunities, and that means that you have to take on a bit more risk. If you're older and closer to retirement, you don't want to run the risk of losing a big portion of your nest egg due to market volatility, and so you'll tend to invest in things that are more stable. Target date funds were created so that you can just choose when you're going to be retiring, and the fund managers will take care of all the allocations for you. In general, funds are set up to target retirement dates 5 years apart. For example, 2055, 2060, 2065, etc. All you have to do is figure out when you want to retire, pick that fund, and the fund managers will do the rest. Most brokerages have target date fund options. If you have M1 Finance, all you have to do is hop over to the Research tab, click Preparing for Retirement, and then choose your retirement date. They also have different options like conservative or moderate or aggressive depending on your risk appetite. Whether you choose an index fund or a target date fund, either option is great, especially in a Roth IRA or a 401k. The most important thing is that you get started. Thanks for hanging with me, and I hope that this video was helpful for you as you start your investing journey. If there was anything that didn't make sense, please leave a comment down below. I'd be happy to help clarify the things that didn't make sense. If you're interested in learning how to research individual stocks and companies, I'm planning out those videos. So make sure that you hit the subscribe button and the bell icon so that you don't miss it. If you liked what I had to say, go ahead and hit that like button and maybe share the video with a friend. As always, thank you so much for watching, and I'll see you next time.